Hey everyone, this is Ben. I do the All in the Reflexes Substack. You can find me there. I also, my videos are cross-post onto YouTube, and then I'll post charts and ideas once in a while on X as they occur to me, and a few memes here and there as well. Yesterday I did a couple of videos, one on economic data and one on market timing signals, and today I'm going to take a look at seasonality, cycles, and a couple of interesting charts that I may or may not pursue in the near term. But just in general, everything that I share is intended to be educational. I like to share things openly. It helps me to keep track of my progress. I get questions and ideas from people, and they're just really helpful in my own development and progress in the market. But don't like to take very specific trade ideas or setups from other people. I find that when I do that, it underperforms. Finding the right fit for my system and style, and I think that's really where our edge comes from as investors and traders. But sharing together helps us to get there. But long story short, you won't hear me sharing is something that I think somebody else should specifically do. Getting that out of the way, we'll start with I guess just to recap, what we shared yesterday. Economic data from the lens of, does it support an optimistic outlook for market participants? I don't see anything in the economic data that would suggest that market participants should shift to fear, and it doesn't mean that they won't, but I don't see anything there that suggests that there's an underlying concern. When we looked at the timing signals, there's a little bit of erosion on some of them, but we're still majority green, none red. But the breadth metrics are probably most concerning, and so the reason I want to reiterate that is that we'll start with seasons and cycles in this video, and we've spent a lot of time on breadth yesterday, but those are conditions, and when I have a condition in front of me that's concerning, it guides me to use a smaller position size with anything new. Start to take profits in things that have run really well, or consider closing things that are already underperforming. But I generally, I might be like more risk averse, but it doesn't present me with a trigger to act. So it helps me to prepare myself, but then price is ultimately the decider, and I'll let the market tell us when it's going to take those conditions seriously. And the importance of treating breadth and divergences as conditions is that they can resolve, so they can catch up to price, as opposed to price eroding as a result of them. So we could start to see that broader market participation, and we would not want to form a bias based on the prior data. So starting with seasonality, this is a indicator that you can get on TradingView in the community scripts. It has a histogram with the percentage of times that the month has closed favorably, and at the bottom the average return for that month. And so this is a 20-year look at the S&P. We'll hear people mention sell in May and go away, and then we'll get into July and June, and people will say, well, I thought we were supposed to sell in May and go away, and it didn't work, right? May tends to be 80% of the time it has closed higher, and it's closed positively. June, it's 50-50, and it's just kind of like middle of the road, right? It's historically 0.1%. July is one of the strongest months of the year, but if you follow the Stock Trader Almanac strategy, they separate the year into 6 months, and the strongest months begin in November, and they carry through to April, and those are the strongest 6 months for the S&P. The Nasdaq tends to go through has an 8-month period that goes through June, right, and actually carries a little bit into July, and the July is the strong month, but it's kind of sandwiched in between this relatively flat June, and then August and September are historically have been underperformers, and then October is where, if you're following that 6-month strategy, October is where you like to start to position yourself into where I would look to position into like the things that I think will do well in the growthier part of the year. So why does that work for us, right? In February we have tax deadlines. There's liquidity pressure that materializes at some points of the year and not others. There's a lot of underlying and behavioral things that take place throughout an annual cycle that causes us to see some consistency, but it's not entirely reliable. We get into the presidential cycles, and you've got some very consistent behavior in each of the 4 years of the presidential cycle, and this is the midterm year. So in the midterm year, the middle part is the weakest among the 4 year cycle, and it in June in particular has had only 25% of months closing higher, and an average of a negative 2% outcome. Now, where we have to be careful with seasonality is the people that do a lot of seasonal work, they'll tend to present it as if it's like a probability of what will happen. This is a measurement of what already has happened, and there's a reason that these things only happen a percentage of the time, and they're not necessarily a prediction of the future. We have to use other information to help support a future outlook than past seasonality. And in particular, these last, I want to say these like last 12 to 18 months, seasonality has much of it has inverted from what we would typically experience month to month. So we'll keep that in mind as we look at our expectations over this historically seasonal week period, and will it be reflective of what we've experienced in the past. Now, I've said I don't like to front run breadth, and I don't like to front run seasonality. I do have a seasonal playbook that I use, and I am running with a number of active positions from that. I'm in Apple, and I'll stay in that until the July timeframe. In August, I'll start to trim that position, but I started opening that in February, and I added to it this past month. The semiconductors, right now I'm long. I'm pretty much always long semiconductors, but I'm still long semis right now. In tech, those are really the only things that are doing very well, and I've still got some of this energy position. It tends to do well through the summer months. Natural gas I closed, and then I've got some exposure in utilities, and I passed on the. I just, for some reason, I decided not to short semiconductors in the middle of an AI boom, but I passed on that one this year. If following the 6-month strategy, for the S&P, it would call for closing in April, and then shifting into something more risk averse. I really don't like holding the U.S. dollar ETF. I have at some points, but it's not where I prefer to park money. If taking a more risk-off posture, I'm not a big fan of any of the longer duration Treasury ETFs right now, with rates doing what they're doing. I would prefer to stick to SGov and SHY that are much shorter duration. But that's generally my seasonal outlook. May is not a very busy month seasonally. I'm going to keep on my radar Procter & Gamble and Pepsi. In July, we tend to see a nice boost in the consumer staples. But it usually underperforms some of the others. But staples could look good in July, or could look good, at some point during this month, and then when selling those into strength in September and November, it frees up capital for some of the higher growth opportunities that I like to pursue in those higher performing months. So that's generally my seasonal playbook. I don't follow it religiously, but I do lean on it quite a bit. Then taking a look at shifting from seasonality to cycle work, here's a look at the the Foundation for the Study of Cycles has this app, and I use this as a reference. A lot of times if I want to configure an indicator on based on a dominant cycle, I'll take a look at this, and it'll quickly calculate cycles with stability scores and reliability scores. So looking at the S&P, I'm looking at like 1,200 trading days of history when I run it. I think the default is around 850, and then I tend to stay focused on stability score and reliability score. These also align to cycle lengths that I find when using another cycle tool that I'll pull up in a minute as well. So this would indicate that we're coming up on like a turning point in the early part of June, transitional point in early to mid August, and then one in late third week of October. That aligns really well to what we've seen in our cycle charts, or in our seasonality chart. You've got this transition point in June. You got the flat period in August. You get the bump in July, so you're transitioning from like a rebound up, and then a flatter period in August, and then you're coming out of a September low and back into your high months in beginning in like November and carrying through the rest of the year. So that would align to like our seasonal expectation, and so that's as far as I'll take that one, is just to keep in mind that we have a pivot point that it's anticipating around the June 5th time frame. Now, the thing to keep in mind with the cycle tools is the height of these sine waves doesn't indicate price level or magnitude that we should anticipate. The real value of these is that it helps us to identify a time frame where we might expect a change, and that change isn't necessarily a change in direction. It's not at all helpful for picking price level. It's somewhat helpful for anticipating a direction, but usually, we want to consider this to be a date of interest. Sometimes you get to these and price actually swings higher, and you'll get like a trend acceleration instead of a trend reversal. More often than not, we see something happen in proximity to these dates, but because it's a composite and it's a rounded sine wave, a lot of the times the change will take place like kind of just after it, and so we have to keep that in mind as well. This one's not intended for more pinpoint accuracy. You can find this one through the Foundation of the Study of Cycles, and that conference is coming up in a couple of weeks. I'll be there. There's a lot of great speakers. It's a very, very small conference, like only 100 people. So you really get to talk to a lot of the presenters and see some of their ideas. They go into quite a bit of detail, and a lot of the people in the audience are, I want to say like half the audience is probably experienced and strong enough to present at the conference itself. So just the interaction with the people is fantastic. So that's coming up, and then if we take a look, I'm going to go to we'll go to the timing solutions cycle tool next. And so we want to keep in mind that we saw that June 6th date, and that was of interest to us on the prior app. Now, this one also uses a cycle detection, but then you can plot in cycles that you expect to see, and so it's a different method, right? But I've got two cycles that I've been working from the S&P that have worked fairly well. We've got one is a composite of a 42-month cycle, and that's the kitchen inventory cycle. It's a very old cycle that has been well documented. There's 255, which is essentially an annual cycle in trading days, and so it's working with a composite of those, and then you can see each of these you can isolate the prediction zones of the cycle, which areas of the cycle have been most reliable, and you find that some of it has not been. Let me get the whole thing on the screen. So you've got this prediction zone, and 7 of 7 times in previous years it has been directionally predictive. And then if we were to try, the downward cycle, it's actually a lot of the time it's been up. So it's even though it's showing us a pivot in direction, that one has not been as helpful for us. So I'm sticking with the one with the highest prediction zone. The 42-month cycle has fairly strong prediction zones up and down, but it's also 42 months long, so it doesn't offer you a lot of change when looking at it specifically. We can pull it up in the panel as well. So there's the 42 month and the 255 day cycles interacting together, and they produce the blue composite line. And so you've got like the kitchen inventory cycle with a down wave, and then anticipating a buy zone, and that came in early relative to where we saw the price move in the S&P in this past fall. But the composite line of it lined up very well, and as did this 116-day cycle. And this one I follow more closely. It aligns to it also aligns very well to the cycle of my P&L. It tends to ebb and flow on a 116-day basis, and probably because I do so much work with S&P stocks. But so this one's got a reliable prediction zone as well, and these ones are what's interesting about them is we're at a point where the 116-day cycle is anticipating a pivot around a transition point around the 23rd, 24th, about the 23rd. The longer term annualized cycle in the kitchen inventory cycle have like a partially transitional area, and then the pivot point comes in early July, and now the cycles are kind of like inflecting from one another, where those longer, slower cycles are would anticipate this being a high of a move, and the 116-day would be anticipating it being a low of a move. That tells me that we're more likely to be like choppy or sideways, and then this seasonal area is more of like the sweeter spot for the longer term buying. But the 116-day cycle really at this point falls out of sequence with that typical annual behavior that we've seen. This would call for us pivoting in early July, and then like if we were to take them directionally, swing low July, swing high into mid-September. It's generally not the behavior that we see, and then low in the fall. But so what that forced me to decide is, do I think that the 116-day cycle is going to be reliable over the next 3 to 4 months, or do I want to defer to something longer? I'm going to let, like I said earlier, I want to let price be the guide point. But anyways, we've got a pivot point that we'll keep an eye out for in later this week, and then we recognize that the next major inflection points occur around early July, and then into late August. So that's the timing solutions cycle. Another look at timing tools. This is the timing solutions platform. One of a couple of the indicators from the timing solutions platform. This is where it gets a little bit esoteric, and you have to be open-minded if you're not into financial astrology. But I found that when I have confluence with things that appear in the financial astrology space, and then my traditional technical analysis, the confluence of more than one discipline tends to indicate a pivot point and more reliably than a single discipline by itself. So we were navigating descending angles in the Gann fan, and then price began to find support and resistance more consistently at the horizontal lines, which are calculated with Gann square of 9. We gapped our way out of the descending angles and over a support level. That's a very bullish type of behavior when you're looking at these types of tools as guide points for support and resistance. And then we immediately begin navigating ascending angles in the Gann fan. These are anchored to the eclipse season. Eclipses tend to see volatility and transition points, and they're usually fairly short term, and then we resume a longer term trend. And so now we're navigating an ascending angle, and we're coming back to find support at a combination of the ascending angle and these horizontal support and resistance levels. So that's fairly bullish. As long as we stay above, I want to say about 7,200. I consider this to be, anything that retraces and retests 7,200. I'm going to consider that to be a healthy retest in the context of an uptrend, and I would find that I would take that to be very bullish. So that's how I'm using this tool, and that's my cycle outlook with it. If we, given what we said about the prior two cycles, we've got the prior two cycle tools. The square of 9 gives us a timeline that's based on it's anchored to the starting point of these two eclipses, and then the distance spaces out in the square of 9 mathematics. You're getting wider and wider in between each of these transition points, and you see that we haven't, in the past we've gotten like more swings and decision points at some of these than we have this season. You can see we've got like dojis at a couple of them. The gap takes place right in between the one from April 7th, April 6th, and April 13th. We got to the one on the 27th. We immediately get a little pullback to support and then launch. And then that happened again on this one from the 8th. We get a little pullback afterwards and we bounce upwards. So the next dates of interest on this tool are the 21st, which is Tuesday. So remember, when we looked at the timing solutions tool, it was pointed to the 23rd, and so we've got confluence with one that's identifying the 21st, and then June 8th, which aligns to that pivot point that we saw on the cycle tool from the Foundation of the Study of Cycles. And then the next one is June 22nd, and then we start to get into then we're out to July 13th. And I would say once we get to this point, I'm probably going to be looking for another another event or key level to anchor to. I find these tools to be fascinating. They at least make my mind process the price levels and price activity in a different way, and I've found that to be helpful. If you're interested in them, you can get them at timetrades.com, time-trades.com, and Blair does fantastic work on these. I highly recommend at least subscribing and following him on his YouTube channel and on X as well. He posts a lot of great setups. So another date of interest that's popping up is this comes from a page in Brad Cowan's book. If anybody has followed him, I'm not well versed in his material like some of the others are, but Blair has an indicator that works with this pentagonal theory, and so the pentagonal time theory is looking at at a pentagram of alignment of planets on the natal dates of the issuances of equities and from key events. And so Brad Cowan starts this one in on the date of the Buttonwood Agreement, which is considered to be the inception date for the New York Stock Exchange. So that means the New York Stock Exchange turns 234 years old as of today. And so Brad Cowan's saying that explains why we see May 17th to 20th often being a turning point in the market. I actually hadn't heard that before. I had it in my calendar to be aware of and take a look at, and so thought, let me take a look at the some of the historical data and see what it says. So again, we've got that. It's saying there's a key date to be aware of from the 17th to the 20th. That comes back to, we were anticipating a date on the 21st from this tool, and the in the cycle tool, the timing solution the timing solutions tool was anticipating the 23rd. So you've got the 23rd, the 21st, and the pentagonal time theory pointing to the date of inception for the Buttonwood Agreement. So taking a look at, I've got a database with the last, with stock data going back to the 1990s. It includes It includes delisted equities, so it doesn't have survivorship bias. And I just said, what are the, just ran a quick run to see what are the, what's the average performance been in the 4 weeks leading up to the 17th of the month, and what is the performance 2 weeks following the 20th and 4 weeks following the 20th. What have those looked like? And so the average, median, the trimmed mean are all fairly favorable leading up the 4 weeks leading up to May 17th, and historically from 1990 forward, that time period is closed positively 60% of the time. The 2 weeks after, the average falls to 0.64%. The median is much lower, and the percent positive is now 53% as opposed to 61%. And then when we get into 4 weeks after, the average is now, the average, median, and trim mean are now half of what they were in the 4 weeks leading up, and the percentage of times positive is down to 50%. So not necessarily bearish, but that tells us this is a decent part of the decent time frame to probably wait and see and look for buying opportunities further out. I found that interesting because I had not seen that before. That was posted by Margot in a while ago in her Discord. You can follow her on X at Margot Amala on X, but she's got some great people in her Discord and puts out some fantastic forecasts. She and Blair have done some sessions with Dale, who does a lot of work on Forex and commodities, and it's just been a fantastic collaboration to see. So that's some of the cycle stuff leading up through May and into the current date, and so now we take a look at how does that guide us on some individual opportunities. So we know that we anticipate this to be like an abnormal period. We've got some reduction in bullish participation broadly across the market. So we want to stay kind of focused on things that are doing well. Energy closed out the last day of last week. Energy was the only thing positive. You've got energy, tech, and consumer defensive have kind of been near the top of the list over the last month. So tech is the leading performer. Consumer defensive has been in the top three over the entirety of the month. Materials made a brief appearance in and out. So when we take a look at specific opportunities, I actually had not seen many charts in energy that I liked as much right now, but I want to start with a weekly reversal that I saw a couple of weeks ago, and we'll use the pipe finder. This thing is an indicator that I coded that just looks for things that have made like a 2-bar reversal on a weekly basis. And we saw one a couple of weeks ago in cybersecurity, the cybersecurity ETF. And so when you find these, they're pretty reliable when you see them on a weekly time frame. And so you've got the 2-bar reversal, and then the third week opens slightly above it, and then closes above the prior high, and that's our 2-bar reversal. It's listed in Bulkowski's book on chart patterns as a pipe reversal. So we found that I don't find them often on ETFs, and that's what was interesting to me. So it pops up on the cyber ETF, and then I take a look at the underlying equities. And so we had one that popped up on Fortinet, and that thing has just ripped from there. And so this is broken above a base. This looks really strong. So I still think Fortinet's a good opportunity. I'll turn the drawing tools back on. It's the only time we'll need to use the pipe finder. So this is on a weekly level. It's had a bullish breakout on the RSI. This indicator at the top is the congestion index. This indicates that the trend is strong, which we can see. And the bottom, this is a oscillator that's based on the relative rotation graph, and so this means that the relative strength to the S&P is in bullish territory, and the momentum of that relative strength is in bullish territory, and that's all on a weekly time frame. And the high time frame is where the trend is, and the low time frame follows. So this is a triple top breakout, and those are strong patterns. So if using the measure of the pattern to forecast, that would look something like, that would take us. You've got a $44 move. I would, say towards the top of the pattern, and some density in the volume profile. The forecast for a move just proportionally aligns to the 2.618 in the Fibonacci level. That could take us up as high as 150. Time frame is hard to tell, right? This is very parabolic, and it's happening right at a cycle transition. Maybe we get up to like 130, and then we come back for a retest. A lot of times we break out of a base, and you get a retest within 1/4 of the duration of that base. So that could be August time frame, and that aligns with a typical area of seasonal weakness. So I planned for two scenarios when I saw this. Said we're either going to get breakout and retest, or we'll form like a cup and handle pattern, and we got the former, not the latter. So Fortinet has already moved quite a bit, and so when something's already made its move, but we know that the signal has come from strength in the subsector. We take a look at some of the other equities that are in there as well. Datadog reported last week. Now I'll shift to daily. Datadog reported, and they gapped way up, and I consider these green levels to be candidates for consolidation and reversal, and it's had this strongly oversold. Oversold conditions are in uptrends are the norm, and they're not sell signals. If you're oversold in a downtrend and you get like a mean reversion and it's oversold, those are selling opportunities, and overbought, right? And if it's oversold in an uptrend, that's a buying opportunity. So you've got this big overbought condition into an area of consolidation. That probably means that we get up to 215 or so, and then maybe we come back down and retest 190 or the top of that base. But that one I'm not as interested in pursuing. I'm taking a look at the themes among them. Palo Alto, very strong. This one's broken above its base, and you've got just a series of candles opening and closing above one another, and then a strongly overbought condition. So this, if it pulls back, maybe we get a retest of the base and an opportunity there. The one that I'm in and that I like the most is CrowdStrike. Now I'm going to take a look at these with a. This is a chart that I'm only recently playing around with, but I've taken the width of Bollinger Bands in multiple time frames to identify extreme compression of momentum and then expansion from it, and then we've got a. This is an RCI indicator that I've turned into a composite. It uses prices correlation with itself to determine whether things are changing, aligning with a higher or long-term, a lower time frame or higher time frame trend. And so when it's bullish, it's going to be up near the top. Reversals from there are an early indication of bearish activity. So taking a look at the combination of these things. We'll start with the cyber ETF. It's common with indexes and ETFs to not see as obvious of a momentum squeeze. We'll get into Fortinet. We've got this reversal on the RCI, and it's a bullish reversal. We were getting into like an extreme compression, and it broke out of that. So you've got this breakout from a momentum squeeze, and that was a strong signal happening like right at the time of the breakout. Datadog, wasn't compressed as much going into it. It's just starting to have an alignment with a more bullish period in its price history. Palo Alto breaking out from the momentum squeeze as well, just starting to cross over, and CrowdStrike looks like it's last in line to make this move, and it's a name that I've been in and out of for a long time, and I'm comfortable with its price movement. But so I like CrowdStrike, and I like the cybersecurity space. I think it's positioned to be higher performing than broader software right now. Let's see. We'll take a look at additional base breakouts. NVIDIA reports this week, and I'm always cautious about playing with earnings, with things that are reporting earnings shortly. Now, turn the volume profile off. NVIDIA's been killing it on earnings, so we've got, its growth in earnings per share and sales have been very, very strong. I don't think the market in general has a bearish expectation for NVIDIA right now, and I certainly don't. We've got the width of this base measured out to into quarters, and the next one would be the tail end of June. The middle of this cycle would be the early part of June, and that lines up with with some of what we saw in the other cycle charts. So maybe we get a positive earnings reaction, and then we start to retrace into those dates. But I would look for, a lot of times you retest the top of a base within a quarter of a cycle, a quarter to a half, and so maybe we start to do that. But I like NVIDIA here. I'm already strongly into the position and won't do anything else with it in advance of earnings. Looking at another base breakout, so I'm trying to order these in like themes of how I saw them, but this is we've had a lot of the data center construction stocks, and anybody who's aligning with that data center construction theme has done very well. So if you've seen like a chart of FIX, Comfort Systems, like this is blown through every forecast that I've come up with, and this is a steeply parabolic equity, and so it's not one that I'm looking to chase any further. I'm taking some profit on it, and I'm moving up some stop losses, and it's something that I want to be in for a long time or stick with. I don't want to get shaken out of it, but I also don't want to expose myself to the risk of a reversal from a parabolic move. The one that I just brought up, Daikin Industries, so they're international cooling and HVAC. Take a look at this on a longer time frame. So I've got the harmonic anchored. Harmonics I anchor to closing price only. I did this in a video a few weeks ago. This follows Michael Jenkins' method, but I find that these levels tend to be, when you identify them, they tend to be respected, and maybe a little bit easier for me to plan for than I used to be able to with Fibonacci levels. So the risk with this one is it's an over-the-counter stock, and so the liquidity is going to be relatively low, and so these present a different risk-reward profile. This is the you've got a couple of tools in TradingView and drawing tools. You can plan a long position or a short position. I'm going to use this one to just show an example of position sizing. So if I'm looking at this, we've broken above a harmonic, and we've got a very strong trend, and it's a trend that's just taken strength with RSI in bullish territory, rising relative strength to the S&P, good momentum of relative strength, and this is a really nice looking basing pattern, and so you've got two things that you want to look at with basing patterns like this, where you're a little bit early to it. We've got a descending trend line that we've broken out of, and at the same time that we've broken out of that descending trend line, we've also broken above anchored volume weighted averages from the high, and then from the second higher. So you've got two levels, and these tend to be areas of resistance. You see, we put in this high, we anchor the anchored volume weighted average to it, and then price rejects at it, and it does that a number of times. And you finally break above it, and it rejects it well, we didn't have this line at that point. So it rejected at a harmonic, and that gives us an opportunity to set a new anchored volume weighted average, because this tried to establish, it tried to recover, and it failed. And so now they're both treated as potential areas of resistance, and now it's above both of them and above a harmonic level. So that's multiple things that I like. Above a descending trend line and breaking above two anchored volume weighted averages that were previously resistance. Now I anchor a second harmonic to the low and the range of activity that we're seeing. Because this is over the counter, it doesn't really have, it's not an institutional stock. So this method is really strong with things that you think have a lot of institutional participation. That's not the expectation with this one. But I'm looking at, if it, as long as we were getting into it, and if I'm getting into it like in the early part of the harmonic, I can set my stop below this gap. This is not a very liquid stock, so there's more risk of like an abnormal movement to it, and somebody's buy and sell order manipulating the behavior. But I would look at a close below this gap is riskier. This is less than 3-to-1 reward to risk if I'm targeting this 1844. I would look at that as like the initial level. Once you're above the descending angle and above the anchored volume weighted averages, a challenge of the top of the base is on the menu. So so I think the potential is a bit higher, but I would look to start, I would personally, for my style, I would look to start taking some profit into that first level. So let's use this one, and I just threw together a quick template. I've got this, a different version of it in my own trade log, but so this is how I like to treat position sizing, and this comes out of, like all over the place here. This comes out of a couple of trading books that I've used, and this is a process that I like. So full screen. Trying to get both of them on the screen at the same time. All right. So we've got, sorry about all that. We've got let's say we're working with a portfolio that's $10,000, and for each trade I don't want to risk more than 2% of the position. There's a couple of considerations, a couple of things I take into consideration. We've talked about, we've got market conditions, and we're not bearish. We're in an uptrend, but we're relatively uncertain right now. So I'm going to say that half of my risk decision is based on the condition of the market right now, and so I'm going to stay within this column of uncertainty. Then I've got what's my conviction for the trade? Is it high, medium, or low? And then what is the risk reward? So the best risk reward, that the things that I'm going to allocate more heavily to are going to have a risk reward greater than 4. And so now we'll take the levels from the equity that we were just looking at, and so if we're looking at an entry around 16, and a stop is, let's say we'll call it 1490. I don't like to use even increments when I do these. I generally like them to be a little unique. So and then entry is 1603, and then we're going to take profit initially at 1844. Oh no, I'm sorry. The entry that we're planning for, I'm going to look for it to come all the way back down to close to the top of that harmonic. So the entry level is actually 1588. And so that gives us a 2.7 to 1 risk reward. I want to say moderate conviction on this one. It's an over-the-counter. I'm going to stay low on it. So it's an over-the-counter stock. Market conditions are a little bit uncertain. So I'm going to combine the allocation with my outlook on the market, my conviction for the trade, and the risk reward. So we've got a, let's say low conviction, uncertain market, and uncertain market with a less than 3-to-1 risk reward. So that's where we said normally would take a maximum of 2% risk per position. We're only going to take 0.25%. And if I had a $10,000 portfolio, that means that my per share risk on this trade is 95 cents. Now, this model doesn't account for slippage. You usually want to assume that you're not going to get your target price when you're stopped. You usually get some drift, and but in this case, we'll just keep it simple. So you've got 0.25% allocation, 0.25% risked on the portfolio, and then we're going to take that 95 cents, divide it by what would be 0.25% of 10,000, and that gives us a share count of 27 and an allocation amount of $428. That means that we're going to take on $26 of risk, but we're going to allocate for over 4% of the portfolio. So when you say how much money am I risking per position? Oops, you just got to look at my screensaver there. But when we say we're going to take on, we only want to risk 2% of the portfolio, that can be more than $10,000 sometimes, depending on where the stop is, and so we're taking 0.25% of risk of the portfolio in a $400 trade is what that template would guide us towards. So that's position sizing and how I use it with my outlook on the market, my conviction for the trade, and the reward to risk. So I think that's enough on that equity. Another base breakout that I saw, and this is interesting because it's an insurance name, and it caused me to go back and take a look at some of the other insurance names. So if you saw the video where I looked at the breadth indicators with point and figure, we had one that this is the only one that had a bullish screen on Friday. And it's SIGI, Selective Insurance Group, and then we also had this other one, AIZ. And so we've got you've got a descending trend line. We have not broken above it yet. We can anchor a volume weighted average and put that up there. We'll take a look at the volume profile. And so it's coming above, like trying to work its way above an area of density in the volume profile. We recently had a strong oversold condition, and then but it did not make a new low on that condition. So now we've got RSI above ascending moving averages. Your relative strength to the S&P is improving, and we've got some trend strength. I'm going to say if this one, the behavior that I'm going to be looking for from this one is, if it gets above this ascending line and then comes back down and retests about like 89, I would be interested in it possibly coming back up to challenge this area of density in the volume profile. So I like this one. If I see those behaviors, I would look to probably get involved with it, in this fashion, right? And then I would use this area as the stop, just below the $89 harmonic. And so again, we could take that back into the template, and you've got $2.66 that we're risking, and we'll just do like one more of these. So you've got, let's say we were interested in this one in, at an entry of 90.58, taking profit at 99.85, and then a stop at 87. 92. You've got now you're working into like even if we're uncertain about the market, we're now saying oh, this is a higher risk reward, and now I'm going to allocate 13% of the portfolio, but only risking approximately $40. So that's that's the last example that I'll share on the position sizing relative to these trade opportunities or ideas. Now we'll take a look at AIZ one more time, and then we'll look at both of them on the point and figure as well. So AIZ is interesting because it's already broken out of its base, right? You've got kind of a pennant pattern here, a rising. It's kind of like squeezed and broken out. So this is an area where we might see a little bit of consolidation, but if it comes back down to maybe the middle of this gap, middles of gaps are always interesting to me. If it were to come down to the middle of this gap, and then we saw the market lean into it, that I would take that to be very strong behavior. So if you come down, test the middle of a gap, and we got up to about here, about 251, I would be interested in probably grabbing it there, and then for an opportunity towards the top of the next harmonic, and then that lets us use the top of the basing pattern as our stop, right? Because if it goes below that gap, so you're pretty much like you can work this out to about like a 4-to-1 opportunity based on those proportions. Now we'll take a look at each of these with the point and figure charts. The first one was SIGI, and so that's got already showing a double top, which is interesting because when you look at the the pattern and the time-based price chart, it has not broken out yet. But in point and figure, where you're only looking at 1% increments of movement, it's actually in a breakout condition already. So the point and figure has led the time-based price trend. Now we take a look at AIZ. This one's also in a double top breakout, and I'm not hearing anybody talking about insurance right now. In fact, like the financial sector has not done as well, and insurance has relatively been off the radar. So let's take a look at the momentum of those ones as well. Nothing on this one. The AIZ one is relatively squeezed, and your relative coefficients are starting to trend higher. So this one looks pretty good. I'm going to keep that one on the radar. A couple of others. Let's take a look at. We'll take a look at the insurance ETF. So this, like we said, you don't always see momentum squeezes on the ETFs themselves. This is highly compressed, and this thing has gotten into like a very, very narrow range or very tight consolidation. You tend to get very explosive moves out of consolidations like this. Whichever way it breaks is going to be decisive. I posted earlier today. Turn the drawing tools on. We had this multi-year consolidation with Exxon, right? And then you get a breakout from it, and it just turns into a very, very steep move. Excuse me. So you had this, this basing consolidation. So this is the width of Bollinger Bands on daily, weekly, and monthly time frames combined, and it's weighted so that the monthly is weighted 3 times the daily, and the weekly is weighted 2 times the daily. So you're putting more weight on the longer term momentum squeeze, and that's what tells you you're building yourself up to a powerful breakout once it does move up ahead of it, and you start to reclaim a trend ahead of time. So the signal moved earlier, and then the momentum confirmed it later. And so we'll take a look at AIK again, IAK, the insurance one, and this could be. This has been compressing since the fall of 2025. it's not something that we take action on until we have that break above or break below. I would wait for that, but this tells us we're seeing a couple of names within the insurance space that are doing something interesting, and the ETF itself is very, very compressed. So that looks interesting to me. A couple more that I want to take a look at. Copper. So I think I'm done with this chart. So if we look at the retail ETF for copper, I was in a trade for it. I think I've still got somewhat of a position in it, but I had moved my stop up once we got into this overhead harmonic, and some of my position got stopped out. I'm going to say if we get back above this, this 39.90 level, if we get down to 37.30, I'm going to allocate more. If we break above 39.90, I'm going to allocate more. I want to see this, either find support for additional allocation or break higher. I'm going to hide these right now. But we're above an ascending angle in the GAN fan. This is based on a cycle length, and the proportions of it are 5 cents per trading session, and so it's been a relatively consistent and reliable proportion of GAN fan. But this is the retail ETF for copper, and it's not as strong of a perspective as we get when we look at the commodity. So I'm going to take a look at the cycle. This is the one. Yeah, here's the copper. There's copper as a cycle, and this is on a weekly chart of the commodity, and so this one's fun because it's got copper actually follows pretty consistently the sunspot cycle. I know that when you do get electrical activity and interference with sunspots, could drive some demand for electronics or repair of grids, things like that. But I wouldn't expect that to be a driver for an extreme driver for the commodity itself. It's probably just more of a correlation. So you've got a swing highs plotted out in transition points, kind of all converging around the early part of 2027, and then a neural, kind of a dynamic neural model of cycle that it calculates, where it's anticipating this to be this low that we saw in the around March 17th to have been the swing low of this portion of the cycle, and that takes us into like the midpoint of 2020, early to mid 2027, before we see another large transition point. So we've gone from one large transition, and we've got a long runway into the next. Looking at the commodity for copper, and then if we take a look at the COT report, this is where it's interesting to me. We've got the commitment of traders report. If you're a large trader, if you're a trader over a certain size, and if you're a producer who's using the futures market to hedge and to control your pricing, you have to report your trading activity. And if you're small enough, you don't have to trade like all of us, right? So we don't have to report our trades. And so the difference between what has been reported and what has actually been traded is implied to be the small trader. So the blue level is calculated and assumed to be small traders. The green level are the commercial producers, and when producers are bullish on and produce, like when they're bullish on their the commodity that they're producing or selling, they hedge their position and sell contracts, and so they're like net short. When they're not selling, they don't sell, they stop selling contracts, and they shift into like a net long position. Large traders are always on the opposite end of that trade, and so when large traders have gone, when large traders have taken a bullish position a net long position in copper, we've seen some very large upward movements. So we got one, back here in back in March of last year is what started this upswing. We've got the one that started in June of 2020 that ripped all the way up to the early part of 2022, and so this one's moved pretty steeply already, but we know that this is a very long cycle that where we're looking at a transition point like out into 2027, and so we've had this little retrace this week, but the small traders have reduced their positioning while the large traders are increasing, and the producers are continuing to hedge themselves net short. So that tells me that the small traders got scared out of it a little bit early, and there's still a lot of opportunity for copper. So I'll be looking for that pullback, and if I see it, I've got a game plan for where I want to participate. There's two more that I'm going to take a look at, and the first one is a long opportunity, and this is a little bit different of a charting style, but this is we've got a long-term position in AbbVie. It's dividend growth pick. They're if you're not familiar with them, they're a pharma company. I think I've got three more that I'm going to look at. Yeah. So so they're a pharma. They do a really great job managing their patent cliff. So they tend to manage their pipeline very well, and they're fairly consistent from a cycle and technical analysis standpoint. So I've been able to build up a really nice position in AbbVie just by trading it in and out of its support and resistance levels. So I'll take a look at it with the regular chart. So on the daily, so this is a little bit more contrarian. We've got we can make a case for there being an inverted head and shoulders forming, but it's descending, so that's not as good of a sign. We want it to break through and break above the anchored volume weighted average that from our lower high in March, and then it's probably going to run into a little bit of resistance at 220. But once we clear that, I'm looking at like a scenario where it gets above here, probably comes back down, and then into the dense area of the volume profile, and then maybe a move above, and then onto like a test of the base, of the top of the base. So that would take us, you've got this fairly consistent cycle. We'll take a look at it with the cycle app. So the cycle app is anticipating a swing out of the low somewhere around the late part of May, or mid to late May, and then a swing high into September. If we look at its historical seasonal performance, it's a company that tends to be a bit flat in those fall months. You get a little bit of a pop in July, and then it follows the kind of like best 6 month format, where it has a strong end of year and a strong early part of the season. So so we've got support at overall a higher low into this harmonic, and the anchored volume weighted average from May of 2024. And now what caught my interest with it is on this chart we're using there's three things that are interesting here. We've got an 8-period average directional index, and this is from one of Larry Williams' techniques. So you get above, he calls it the pinch punch, but it's really just an 8-period ADX. When it gets above 40, you're into like a strong and potentially exhaustive trend, and then it comes down, and you can be prepared for a mean reversion. So this is a really good indicator to use with a mean reverting system. When you see it in the context of a steeper down move, now this is potentially a low for us, right? You're into some support levels. We had a deeply oversold And this is a multi-time frame RSI, so it's combining a 5-period RSI with a 40-period RSI. So it's very fast and also very long. And so you've got a bullish divergence. Price made a new low, but momentum on higher and lower time frame made a higher low, and that happened right after an exhaustive shift in trend. So those two signals alone suggest that this might have been the low of the move, and that we're probably now is probably a time for a long-term holder like me to consider pyramiding into the position and leaning in a bit more. The very bottom indicator compares the difference between intraday movement and overnight movement. And overnight movement is more associated with retail traders, and intraday, where the position holds, is an institutional behavior. And so as that shifts positive, we can see that happened into this low. In prior lows, institutions were still selling, and they were driving the low. And here it was flat, right? But this low that was deeply oversold, this is was intraday movement of money and not overnight. And this climb out of the low on April 29th occurred with intraday money, and it formed a bullish divergence. So I like this one where it is. I would I'm considering putting a little. I did add some a couple weeks ago when we got the deeply oversold. I'll probably add a little bit more now, and then more as we see this behavior that I was anticipating. If we start to see that play out, that's where I'll want to keep staging in as I go. I wonder if that one had a point and figure. Yeah, we'll take a look at it with point and figure. So on the point and figure chart, we don't have a breakout yet, but these 45-degree angles are meaningful because the boxes are all proportional, and so if we get above 215, this will trigger a point and figure breakout signal as well. And in my trading system, anything that where I've got positive signals elsewhere that is also accompanied by point and figure have been some of my highest performing of the last couple of years. So that's enough on AbbVie. That's one that I like. Take a look at Ouster's interesting. It's this is tech and semiconductors, so we want to know if how those are performing. If you get a broader sector reversal, this is more risky. But Ouster came up as showed up on my screening for strength with the relative rotation graph, and again we've got a situation where where the stock has broken above the anchored volume weighted average from its prior high, and now notice these two anchored volume weighted averages. There's a purple and a red. If you've seen me do any of this type of work before, you know that I use the purple anchored volume weighted average. I like to set at IPO, and the reds I always put on high. And so you've got the all-time high, you've got IPO. That's all kinds of squished in. We've got our harmonic ranges defined. Actually, we'll zoom out one more time. So defining our consolidating harmonic range from the very top, you can see it dips into negative numbers, so it's a little goofy, right? But these are levels that that the market has navigated within, even on its steep descent. All right, so you had we had our harmonic and our first level of resistance, and then you've got equivalent spacing in between. You get your first area of support, bounce back, you come down, we fail in the mid part, and so it's navigated that that contracting, declining harmonic very well. We'll go back into the daily level, and assuming that this was you've got these this is our breakout from the low, and we're forming after a large extended base, we're forming a second base and navigating a bullish harmonic. I always use solid lines for the bullish harmonics. So you've got our steep trend out of it. We make a case for this being like a ABC type of correction down, and now the next question would be, what kind of breakout is this? You could be looking at, and I'm not a huge Elliott wave guy, but it's helpful for planning, right? So this could be an ABC correction up, and then it goes back into a reversal again. Maybe it only goes to about here, and then you start declining again, or is it a 1 through 5 up, and we don't have a triangle from 1 to 2. This is a pretty clean movement back. Now, if this is a wave 5, a 5-wave pattern, I'll remove the ABC. So we don't know, is it a 5-wave or is it an ABC? We don't know until we see that your wave 3 has topped and then found support at wave 4. But what we could do is we'd say, like, if it broke above here, or if we want to add on like a retrace back down to 32. Well, we don't know if it's an ABC or a 1 through 5. It doesn't matter. We can put our stop right below A. So if it's 3 waves up and it fails, if it's really a C and it fails, it's gonna violate the top of wave 1, and we would exit it anyways. So you can use the what you believe to be the first 2 moves of an Elliott wave pattern as an area to set a stop. And if we were to do that, we're looking at a retest of this harmonic level, and then setting our stop at a violation of both that declining trend line and what would be the top of wave 1. That gives us like if we set it more reasonably, we're still probably looking at like a 3-to-1 risk reward, but that's a 32% opportunity. So continued strength in semiconductors. This is one that I'm looking to probably do a smaller speculative opportunity with. Where else did we see this one? We'll take a look at the point and figure. I think so the point and figure warns us that this is a long tail up, and this just says that the point and figure thinks it's not bearish per se. It's still got a bullish target that's way above current price level, but it tells us that we're in a very extended run. These aren't very good at predicting when it reverses. It just is a warning that we're not early to the move, which is interesting again because it looks like it hasn't moved very much relative to its proportions. So that's Ouster, and then the last one that we'll take a look at, this is a bearish opportunity, is and this is probably a decent one to keep an eye on and see if it becomes a broader trend. We've got Victor Corporation, VICR. And so taking a look at some different, we had those breadth metrics that we looked at the other day where we're saying, we've got more companies less companies participating in bullish breakouts in point and figure, and more of them participating in bearish breakouts. And if that's the trend, we take a company like VICR, and I screened for what are bearish signal reversals that we could find with point and figure. And so we've got this one that's a signal reversal. We get down to like 253 to 250, and we're going to be looking at like a double bottom breakdown. And so this one is showing signs of reversal. Now we've got the indicator that we just looked at with AbbVie, and in the other chart we said we've got with AbbVie we looked at it and we said the 8-period ADX goes into this exhaustive territory and then it returns, and you can see it did that at the beginning of the trend, right? And it wasn't necessarily bearish, but you're at the start of a trend here, and you get a shallower pullback, and now your pullback is steeper, and we've got like some sloppier kind of movement up here. So looking at volume candles with it, you've got an oversold condition that's followed on RSI, that's followed by RSI making lower highs and lower lows, and finding resistance into descending trend lines. At the same time, we're starting to lose momentum in that intraday buying, and so that this tells us that intraday selling is about to overcome any retail buying that tends to take place with overnight decisions. And we had this large candle, popped up on the 11th of May, and it's got very small wick above it and below it. And then after earnings, we had this big earnings reaction that was immediately followed by a high wave candle. So there's a type of doji where the open and the close are very close together, but the high and the low are very far apart. So this is like an indecisive candle. And this is where we started to transition from intraday institutional buying to more emotional retail type of participation. This introduces the opportunity for a short opportunity for me. So if looking at this as a short opportunity, a method that I learned when I first started trading is I use these RSI crossovers, and that's where I anchor my Fibonacci extensions and retraces. And so using one from the very start of this move, and then one from where we made the next bullish leg up, we've got two Fibonacci retraces to look at. And so before we get into those, this is a 13 period RSI. It's declining, so you got lower highs, lower lows into declining moving averages and finding resistance in them. So this is bearish. The momentum of relative strength is starting to roll over. It's flattened out. It's not quite bearish yet. This is still technically a strong uptrend. So you want to be careful, shorting uptrends. But I think this one probably is a candidate for a short. So how I would do it, middles of gaps are, I always talk about the importance of a middle of a gap. If we were falling, if this was, let's say the candle was higher and we were retesting a gap, anytime that the bulls step in and defend the middle of a gap is very bullish, because that means that they didn't want to wait for the gap to close before they started buying, and that suggested that other participants were waiting to buy and they never got their chance, and now price is going to run away without them. That's very bullish. And the same happens in a bearish market. If price starts to climb and people that are holding this equity, institutions and individuals that hold this equity sell into the middle of a gap, they're looking to get out. And so if this anchored volume weighted average is resistance for it, that's where would look to open a short, and then I would target a combination of the 786 from the shorter term Fibonacci range to the 382 of the longer term as a potential price target for me to close a short opportunity. So this could be a 4-to-1. I do think that we'll probably find some support, around this 236 and 618, and the anchored volume weighted average that goes back to the April 7th gap. Notice this is a gap that was never retested, right? And sometimes that happens as well. So you've got another one down here. These are called runaway gaps. This is your breakaway gap, and then all of the gaps that follow are runaway gaps. Breakaway gaps start at the beginning of the trend, and then you get a couple of gaps, and then it starts to this one's more of a exhaustion gap. Eventually, if this does turn out to be a trend reversal, you've got breakaway gap, runaway gap, exhaustion gap, and now this could be a breakaway gap down. This is our first large gap down in this activity. And what's interesting too is you have this large volume candle. All of the activity that took place in the 3 sessions following from open to close was inside of this large buying candle, and so now you've got your movement where you're breaking directly below it. So that's a pretty bearish look to me. So this is the only one that I'm considering as a short right now, and I'm not sure if I'll take it or not. But if we actually, I probably will take this one if we do see that movement into the middle. I need setups to be really compelling for shorting, and I thought that was going to be the last one. I'm going to take a look at perimeter solutions as well. So Perimeter Solutions had a this one's kind of fun because these are like you've got let's see, I'm trying to remember what screener this came up on, but so yeah, so you've got a triple top breakout from the base, and but you've got you've got this kind of like fake out. Yeah, so you've got a failed breakout, and then you've got a shakeout, and then you're back above. Now there's a chance that this is already a completed 5 wave, because your 4th waves like to come back to roughly the middle of a wave 3. So this could be 5 waves up already, but if we look at a measured range, we could suggest that that Perimeter Solutions is a candidate for like to align the forecast with the dense area of volume that was retested. So this is like the area of volume that it had to depart in order to make the extension. And so there's a possibility that we've got some room for a move up to like 37, 33 or so. I would look for these 2 small indecisive candles. I would look for this to be the area where the market does make a decision. If it goes through them, so maybe we take the top of this gappy area, but so maybe we look to maybe I would look to take an interest in it if it comes down to test this area where we've got this indecision point, and look for that to become a decision. And then if the decision is no, and it falls back below, then this could be a 16% opportunity with a 6-to-1 risk reward. This is a company that makes fire retardants. I think they've got I think they're a very large moat company as well. So so this one's, I think, an interesting play. It's something that might do well if we see rotation out of semis and AI stuff for a little bit. But so that one's last on the list, and we'll take a look at the point and figure as well. Yeah, no pattern. So it's got a bullish price objective, but we don't have a pattern. We would have a breakout above 35, 34.50. And that's the last one. So hopefully this was helpful and gives others ideas, at least an explanation of how I size up opportunities as they come across. But if anybody does have questions or would like to look at a stock together or send me one to take a look at, please feel free to reach out. But thanks for watching, and be careful and have a great time in the market. It should be an interesting few weeks. Thanks, guys. Bye.